The brief background is I work with entrepreneurs and investors in what I call complex markets, but basically they're areas that are really inefficient and where capital is scarce. Oftentimes that's emerging markets geographically, but also have been dabbling in the life science space over the last couple of years in developed markets. So I'm going to shut off my camera and I'm going to try to share a screen and do a presentation in real time, PowerPoint style. And I'll share these slides on the Discord afterward so that anyone can dig into them, and my contact info is in there as well. So if you have questions afterward, ping me. I'm trying to leave lots of time for questions in real life, so I'll just hop to it. So let me shut this off. Share.
Just a quick point of order. If you could just drop questions in the chat or in the Discord voice matter, and I'll make sure I scoop them up and get them funneled to Mike if we've got time.
Okay, can everybody hear me and see a full screen?
Yes. I can anyway.
Brilliant. Okay, so first of all, thank you, Matt, for inviting me to speak with you. It's really quite a fun way to start the year, and I'm super jazzed to be exploring this question, which has been occupying more of my own headspace as of late. And so the question that I'd like to pose with this discussion is, can crypto solve the $4 trillion financing gap that besets small and medium-sized enterprises in developing countries? So I think it can. And in this lightning talk, I'll try to explain why. So first, I'm going to talk about the problem, what it is, where it is, and why it exists. Second, I'm going to try to discuss the shortcomings of existing non-bank intermediaries. And I'm going to focus on private equity funds, which have tried to fill this financing gap, largely with the support of development finance institutions, but they have generally failed to deliver solutions at scale. The third piece I'll tackle is laying out crypto's potential solution to the problems. And then I want to hit on some of the challenges that could throttle the development and adoption of such a solution. And then we'll wrap it up with hopefully some robust Q&A. Okay, so what is the problem exactly? In a nutshell, more than 130 million businesses in developing countries have an unmet demand for financing of $4.75 trillion. Now, anytime people talk about trillions of dollars, it gets a bit nonsensical and absurd. But these figures can give us a sense and confidence, if you will, that this is a big problem. And so who basically constructs this financing gap? So of that 130 million businesses, more than 117 million of them are micro businesses, which are businesses that employ fewer than 10 people. And here I've got a picture of a merchant in Rio de Janeiro peddling some chopped Brahma and some snacks. And so that's kind of what you'd think of as a micro business. And despite representing 90% of the number of financially constrained businesses, they only account for about 13% of the financing gap of about $600 billion. And by contrast, roughly 13 million SMEs, defined as businesses between 11 and 250 employees, such as a small textile mill in India, they account for more than 85% of the finance gap when measured by dollars. And so I'm going to focus on this segment, the SMEs, but because it has the greatest capital requirements. But it should be said that there's no reason why this prospective crypto solution wouldn't apply to micro businesses as well. Okay, so on to where is it? So where is the finance gap located? So one answer to this question is it's in a handful of countries. And on this chart, you can see the number of financially constrained SMEs on the y-axis and each country's share of the dollars demanded along the x-axis. And what you see is that 5 countries account for nearly 70% of the unmet capital needs. And 2 of these, accounting for half of the market opportunity, are effectively off limits. So you have China with a closed capital account, a command credit system, and copious restrictions on foreign investment and crypto. And then, of course, Russia, which is sanctioned. The other answer to the question is that it's everywhere. No matter where you look, in every single country, there are enormous unmet capital needs. And the data we have here from International Finance Corporation are only focused on sort of emerging markets and developing countries, but the finance gap exists everywhere. It exists in the United States. It exists in Western Europe. So it's a global challenge. So why does it exist? So why does this massive finance gap exist? What are the root causes that we see? So the first challenge is local banking systems, and this takes two forms. So the first is outright access to banks. Despite advancements in financial inclusion, it remains exceedingly difficult for companies to secure loans. And the second is that the banks themselves are quite risk averse. In general, they extend plain vanilla loans, so asset-backed or collateral-based lending, and they eschew sort of cash flow-based financing. And this overall sort of serves to dampen the availability of credit. The other piece to this is that local capital market development, so stock and bond markets, has been extremely disappointing. So to illustrate, real GDP in IDA and IBRD countries, which is World Bank speak for low and middle income countries, grew by about 180% over the 2 decades to 2020. And that's incremental GDP growth of $21 trillion. In contrast, the number of listed companies grew by only 25% in these countries. So capital market development has lagged far behind the pace of economic growth and far behind the expectations of many of the people who had believed that there would be much greater progress. And you can see this lack of capital market development in the data on access and depth. So using that same database from the IMF that I used on banking, you can see that it's more difficult for companies to issue securities, and that the markets themselves they still remain very shallow in terms of minimal trading in securities. Okay, so local banks aren't fit for purpose. Most businesses are locked out of local capital markets. Many people, myself included, believed that private equity funds could fill this financing gap, and not only providing the expansion capital that these businesses needed, but also providing human capital and sort of expertise in building businesses that's in low supply in many of these markets. Alas, private equity is generally proven to be a disappointment in emerging markets, and I've got a video on YouTube on this and some research on my company's website, so I'll spare the in-depth report, but I really want to highlight 3 key shortcomings of the private equity model, each of which has cascading consequences for the question at hand. So the first is that private equity funds chase institutional investors to raise a blind pool of capital that can be invested in underlying businesses. And these institutional investors, they take a long time to make decisions. Right now, fund managers in Latin America and Africa are taking between 2 to 4 years to raise their funds respectively. And that is an absurd amount of time. Also, these institutional investors, they have this mantra about needing to have a local presence to invest well. Now, I will not deny that strong local knowledge and networks are vital, but this lust for boots on the ground leads these investors to over-index on country-focused fund managers, which, one, not only it ignores potential conflicts of interest amongst local elites, but second, most of these investors, they're lemmings, and so they're jumping into these markets when they're priced for perfection, and the local currencies are overvalued. So they're getting hammered when it comes to performance. And then finally, the last piece is because these institutional investors write large checks, so invest large amounts in these funds, it incentivizes private equity firms to scale rapidly and pursue large deals, leaving the small and medium-sized enterprise segment relatively unfinanced. The second is exit risk. So recall the discussion that we had on the previous slide regarding anemic capital market development. Well, the inability of private equity firms to exit their investments has crushed the performance of most of these funds. And this poor performance has led to billions of dollars being trapped in so-called zombie funds. And these are effectively firms that are unable to raise a follow-on vehicle. And so the follow-on effect from that is that the lack of these distributions means the institutional investors can't recycle money into new funds. It's all just sort of trapped capital in these markets. And then finally, these vehicles are very expensive. So they contain substantial fee drag, not only with management fees, which are typically 2% a year, what have you, but also through transaction and monitoring fees that can enrich managers at the expense of investors. And in addition, the quality of reporting varies tremendously across the managers of these funds, with investors frequently relying on emailed Excel spreadsheets to track performance. Okay, so if local banks aren't going to lend at scale, local capital markets aren't developing, and private equity funds aren't fit for purpose, what's the answer? Well, I think it's an open, permissionless protocol for capital formation. Okay, so in principle, I think crypto can solve the problems we just discussed. So first, crypto rails enable a shift to individual investors that should lead to faster decision-making, enabling capital to get to work faster. It also opens up the universe of investors to just about everyone, just about everywhere. And this expansion of the universe of investors also increases the odds that an SME will find the right size of funding for their requirements, and the odds that an investor could find a company with an attractive financial and even an impact return profile. So sort of the positive externalities of the business. Second, it actually could reduce exit risk. So the tokens that investors would receive in return for their investments are liquid effectively immediately. They could be converted to stable coins or another cryptocurrency on a decentralized exchange. Admittedly, the pricing might be a challenge given the size of the liquidity pool, but that's a conversation for another day. And also, in terms of smart contracts, the tokens would be able to receive airdropped dividend payments, and they could also embed structure, such as a liquidity preference or the seniority in the cap structure of the business that would automatically and instantly convey to new owners when transferred. Third, the tokenization could also create greater alignment and transparency. So with respect to alignment, the tokens could alleviate the principal agent problem and even drive value creation. So for example, you could leverage the network of token holders to reduce the business's marketing spend and leverage that token holder network to drive revenue growth. Tokens could also provide access to pecuniary and non-pecuniary benefits. So these could be limited release products, discounts to token holders, exclusive content, things like that. And finally, assuming there are oracles mapping real-world activity to the blockchain, which is a Herculean assumption, owners could audit the business's cash flows in near real time and map its performance to the stated strategy and business objectives. So that's the optimistic view. The challenges are many and they're immense. So the biggest macro challenge, I think, is the question of crypto adoption writ large, which effectively governs the total number of businesses and investors that could use the protocol. But three that would be specific to the protocol in question are regulation, aggregation, and validation. Okay, so the most obvious one is regulation. So these effectively would be security tokens. And when you multiply the complexity of regulation across scores of jurisdictions, your brain explodes. And so that is migraine inducing. You also face the problem of aggregation, which is sort of getting companies and investors to use the protocol. And last but not least, you face the problem of validating that the participants in the protocol are legit. Part of this, I believe, is tied to the development or implementation of oracles that bring, so-called meat space data on chain. But I also think this requires the development of a tokenomics that can leverage extant networks of professional advisors, intermediaries, and investors to do three things. one, originate investments. Two, hold them accountable for the quality of the deal flow that they generate. And three, allow them to participate in the upside of the business in question. But the beauty of an open permissionless protocol is that you don't have to solve all these problems everywhere. It's extensible, so people can develop innovative solutions across jurisdictions, leveraging the underlying protocol that would facilitate the flow of funds to entrepreneurs or building businesses all around the world. In a world polluted with large institutions trying to jam home top-down solutions at enormous scale, I think the answer lies in decentralization, emergent origination, and the aggregation of small investments at global scale. So that's it for me. I hope that was edifying in a way, and I'm happy to field some questions. All right, are they in the chat window?
So Maya's got a hand up, so
all right.
Let's start with Maya.
Yeah. First of all, thank you very much. It's a very big market failure to be solved. I guess the question I have is, what are the gaps that prevent crypto from easily, let's call it, solving this failure? Is it a coordination problem? Are there technical problems? Is it a trust problem? How do you see it?
Yeah, so I think it's one, there's a coordination problem in terms of everybody agreeing on a rail, like a system of rails to use for it, right? So there's that piece to it. You know, I would hope that crypto, through the creation of stable coins, could help to resolve some of the issues that we face. But candidly, if you're a business in Kenya, you know, it may be ideal to raise Kenyan shillings rather than US dollars, because the investors would be effectively facing currency risk, which has been responsible for most of the depletion of returns. And so there is also that sort of the hard case of currency risk. That wasn't one of the issues that you alluded to. But in general, I think it's coordination problem and just adoption of crypto. I think the biggest throttle to the adoption of crypto is the fact that most of it is full, like the entire space is full of scumbags and scams. And anytime I raise the idea of a crypto business, people think it's speculating on some dog coin. And to me, the potential of crypto has nothing to do with that, right? Like that was that first sort of blow off sort of speculative frenzy. But getting people to conceive of crypto as something that's not just gambling, that is the biggest hurdle, I think, to adoption right now. I don't know, does that answer your question?
Well, it answers my questions. I have a very brief follow-up question. Do you need all of crypto in order to solve the problem, or could you have some sort of crypto light which would solve the problem?
Well, I'm not sure what crypto light is, but to me, it would be crypto light in the sense, to me, there would be some fundamental primitives here that we need to rely on, right? So you basically need the wallets that would have the owners' assets, like the asset owners that would invest capital of one form or another in a business that would need to have a wallet. You need the rails that would convey those funds, and then you'd need, as I mentioned, there are some other elements like the oracles that would be able to capture real world data and bring it on chain. And so there's extant technologies that exist that I think are pretty crypto light, but then there's some extremely difficult engineering that would be required to bring real world businesses to the blockchain. Is that sensible? Great, because I'm just spitballing here. I don't know.
Cool. So I think Ben's got a question as well, so we'll get to Ben.
Hey, yeah, so I thought that talk was pretty interesting. The thing that I think is like going to be the most biggest problem I immediately think of is, aside from the ones you mentioned, how are you going to like enforce anything? like especially for like off-chain businesses and such. Are you thinking you'd be working with like sort of the local authorities, or you could have something reputation based? What are you thinking of in particular?
Yeah, so in general, enforcement in many of these countries is something you want to avoid at all costs. And, people have gotten around that in the past through sort of trying to get collateral in jurisdictions that are enforceable. So, like, let's say you're doing an investment in Latin America, in Argentina, for example. Well, they'd probably try to book the assets in a jurisdictions that's not Argentina, so that you could have enforceability against those assets and that collateral, and have it resolved in a way that's favorable to the shareholders or what have you. I would not even think about relying on existing court systems. To me, the nebulous idea here is that this technology, through smart contracts and through sort of reputation, could help to create trust where minimal trust exists. So, for example, if we take the case of having existing advisors engaged in this process of originating investments, the idea would be to have that advisor, through this tokenomics of the protocol, basically have skin in the game for having brought that investment to the platform or to the protocol in the first place, right? And then they're incentivized, one, by the fact that everyone now knows that they brought this deal forward, A, and B, they should be able to participate in the business's upside if they so choose. And so, to me, it's more of this positive reinforcement as opposed to the relying on a court in, say, Mauritius for some deal in Africa that you then have to find enforcement in the jurisdiction where the investment actually is. So, to me, this gets to the question of regulation, and I think what this protocol might be able to do is change regulation over time, right? So instead of thinking about the way the world is now and trying to fit the crypto into the rules as they are today, this new technology enables us to build a new mechanism for capital formation. And so the idea is to find a way to change people's perceptions of what's possible, and ever so slowly, hopefully regulators would get behind it. But I think that's quite optimistic given the realities and of entrenched interests in many countries, not just emerging markets and developing countries, and the corruption that is involved in that.
That was a very good answer. I think you're pretty spot on with a lot of these. After this meeting, I might want to introduce you to my business partner, because I think you have I think you might be on the same wavelength. But
awesome, yeah, totally.
Cool. So I think we'll go for one more question before we pass over to Dan. So you might have to speed run the answer to this one. So this one from John. I don't know if you want to ask it or I can read it out. Okay, so the question John is asking, he says, can crypto address the Triffin paradox?
Oh, geez, come on, man! I haven't studied economics for 20 years. So the Triffin paradox, which one is that? Is that
So reading from Wikipedia, the conflict of economic interests that arise between short-term domestic and long-term international objectives for countries whose currencies serve as global reserves.
Oh, yes. Well, so okay, yes, this is the giving up the parity with the dollar, like sort of Nixon move. Okay, so I actually think that this idea, I think crypto space and the emergence of stablecoins could actually entrench demand for dollars globally. So I think it could actually work in the dollar's favor. I don't know if this is getting to your question. To me, I think there are two competing trends right now in the world. The first is that large states, China, Russia, others, are trying to build a non-dollar means of settlement and are trying to slowly move away from the dollar as the global reserve currency, with the US basically having all these benefits of low cost financing, low interest rates that have basically fed a consumption economy. And there's that side of the equation. Then there's the rest of the world, where most people live, having access to dollars relative to their local currency would be a boon. And so if you can imagine a world where anyone on planet Earth, instead of owning an account in Naira or Kenyan shillings or, pesos, Mexican pesos, if they could flip that into a US dollar coin, they'd do that immediately. They'd take a dollar savings account any day of the week, 10 times on Sunday. And I think that if the world were able to transact in dollars, most of the world would take that opportunity. So I don't know if that gets to the Triffin paradox per se, because it leads to macro trade-offs that I don't feel like I'm educated or expert enough to weigh in on. But in terms of the demand for the dollar, that's kind of how I think about it. Does that help in any way, shape, or form?
Sorry, Matthew, I didn't hear you call my name earlier, so that's why I didn't jump in.
Oh, no, that's all right. That's all right.
I'm also an armchair economist, Mike. So, but I have an interest in obviously crypto and CBDCs. I think central bank digital currencies are inevitable, but I think I disagree with you on that. I think the paradox is that it's what happened to the United Kingdom after the war. It being having a hegemony actually ends up in a destabilizing situation, and the fact that other countries want the dollar is because of the situation we're in after the Nixon shock, which is why I think we've got crypto. Crypto is a kind of protest against what happened in 1971. So I think the answer is the Bancor, which is, that's the basis of my question. I can't see Bitcoin being the Bancor, but I can see some form of central bank digital currency emerging like that. So.
Yeah. So I totally agree. I think Bitcoin is not the Bancor. I think that if you look at what China's doing right now and what Russia's talking about with the UAE and some other countries, they're effectively trying to replicate the idea behind the Bancor, which was to get a bunch of commodities, a currency based on the relative weight of various commodities. And that's effectively what I think these countries are trying to do now. It's not called the Bancor, but it's what I think is motivating people. And then it becomes a question no longer about the role of finance and whatnot. It becomes the role of access to commodities, which could lead to a very dark future indeed. But yeah, so I agree with you. I agree with you on that.
On that note, so we'll just have to pass over to a second speaker. Thank you, Mike. Anyway, Dan, we're going to put you on the mic now. Mike, I have a few other questions